Look at a steep, vertical market trend, and the standard reaction is to just see raw structural strength. As price action rips relentlessly higher, the psychological pressure of missing out builds, pushing retail traders to slam the buy button at the absolute highest print of the day. Institutions view this exact same chart differently. To them, a vertical market is highly overextended and bound by the physics of mean reversion. When price breaks completely free from its underlying moving averages, it stops being a breakout. It enters a mathematical condition known as liquidity displacement. The market has outpaced its own order book, creating an unsustainable vacuum that is mathematically vulnerable to an instantaneous crash. To map exactly how this happens, we can trace the entire life cycle of a displacement event using the structural framework of the DRW mean reversion architecture. Surviving institutional markets requires tuning out the visual illusion of upward momentum and executing trades based entirely on order book physics. To accurately identify an exhaustion vacuum, we must first define the parameters of a sustainable trend expansion. This animated chart plots a healthy market, a climbing price line supported underneath by two tightly woven moving averages, the 8 EMA and 13 EMA. Notice how price breathes backward, dipping to touch these lines to collect inventory before pushing higher. A displacement event breaks this rhythm entirely. Buying volume accelerates into a near vertical climax. The failure occurs the millisecond the price line completely detaches from the 8 EMA, shooting steeply upward and leaving massive blank space beneath it. Specifically, we define extreme extension as the point when price travels beyond a threshold of 3 standard deviations from its baseline. As you can see, a bright fuchsia-shaded zone now fills this specific spatial gap, highlighting the inventory exhaustion vacuum. Inside this gap, market makers have cleared out all resting liquidity. The retail crowd is left buying at wholesale peaks, absorbing the exact long inventory that institutional algorithms are aggressively unloading. Because there are no resting orders left behind to act as a floor, the order book underneath the current price is completely hollow. Once that 3 standard deviation threshold is breached, the surface-level trend appears invincible, yet the underlying structure is entirely dead, primed for a violent collapse. Knowing a market is overextended does not mean you should short it immediately based on a feeling or a guess at the top. Timing the collapse of that vacuum requires tracking the exact moment institutional momentum begins to decay. This diagram introduces a momentum histogram. The flat zero line represents the gravitational center of market balance. Vertical bars track upward momentum. By observing both panels, we identify institutional divergence. Price makes a final high, but the bottom momentum bars shrink and darken in color. This indicates the market has entered stage 1 of the reversal process, defined as velocity decay. Those downward-sloping momentum bars provide clear mathematical evidence that trading algorithms have officially stopped initiating new buy orders. The execution trigger arrives in stage 2. The mechanical signal is precise. Watch the histogram as a massive, distinct volume bar spikes aggressively downward, cleanly breaking through the zero line. That exact cross signifies the total withdrawal of institutional bid support from the order book. When total bid withdrawal occurs above a hollow liquidity vacuum, it activates the zero-line magnet, forcing price to cascade directly back to the mean. Executing a short position against this reversal demands rigid, pre-calculated exit zones rather than holding the trade indefinitely. Returning to our chart, we see the immediate reaction to the zero-line cross. The high price line drops perfectly vertically, slicing down through the fuchsia exhaustion vacuum. As it plunges, it impacts a new moving average just below the original support lines, highlighting target 1. This level is the 21 EMA baseline, operating as the primary structural line of defense representing fair value. Algorithms place passive buy limit orders here, making the 21 EMA the first profit-taking zone. But the ultimate destination lies deeper. Watch as the price line breaks straight through the 21 EMA, plunging until it slams into a much lower, thicker moving average. This is target 2, the 55 EMA macro shield, functioning as the macro ocean tide of the overall market structure. The extreme gravitational pull of a true mean reversion forces price downward through all the fast EMAs until it buries itself entirely within this baseline. By setting strict structural EMAs as exit targets, traders extract the mathematical countertrend premium and step out of the market entirely before unpredictable noise resumes. The cycle concludes by observing the immediate aftermath of the price striking that 55 EMA terminal target. This final animated diagram shows how the rapid downward price collapse instantly obliterates the statistical spread between the 8, 13, 21, and 55 period moving averages, compressing them violently together into a tightly packed horizontal gray band. We identified this specific, highly constricted market state as fusion compression. Mathematically, the system recognizes that the spread across all the moving averages has fallen completely below its standard deviation bandwidth. During fusion compression, the trading environment goes completely dormant. Volatility dies out and price action flatlines. This uniform gray ribbon confirms the market has returned to a state of absolute mathematical equilibrium. The system has completed its full life cycle, expanding into extreme displacement, reverting violently through an exhaustion vacuum, and settling back into zero-point balance. The market is now fully reset and caged within this compression zone, passively storing latent kinetic energy required to birth the next massive structural expansion.